Okay, welcome back. We're going to go over some of the history of the Forex. And I'm going to make this a boring, stuffy history lesson, but it's important that you understand the market that you're going to trade. The foreign exchange market, as we know today, originated in 1973, but it's been in time, in some form or another, been around since really the time of pharaohs. So you're talking about ancient Egypt. The Babylonians used paper bills and receipts. Really was the Middle East money changers that first started currency trades, and simply where you're exchanging money from one form over to another. So if we wanted to change dollars into pounds, or we wanted to change dollar into euros, we would have a currency exchange. And if you've ever gone from one country to another, in the States, you've ever gone from, say, America to Canada, you had to exchange your money. You've gone from America to, say, Mexico, you had to exchange money. So that is considered to be foreign exchange contract or a foreign exchange transaction. So around 1973, when the Forex market first started going, it was because of what was at the time the Bretton Woods Accord. And Bretton Woods Accord happened when countries started leaving what was called gold standard, and they went from what some people would call lawful money into currency. The currency market was born once countries left gold standard. So what happens is you have a currency or money that is now free floating, which means the rate of exchange, remember we talked about exchanging dollars for, say, euros, the rate of exchange will then fluctuate. Some days you might be able to exchange your $1 for, say, $1.25, or I'm sorry, this would be 75 cents in euros. Other days it would be you're exchanging your $1 for 85 cents in euros. Okay, so the exchange rate will fluctuate both up and down. Now, in the Forex market, 85% of all the transactions are hooked up to the US dollar. So when we talk about the Forex market being 1.9 trillion to 2 trillion per day, you have to realize 85% of this is done in the US dollar. Now, these US dollar pairs are the euro, the pound, Swiss, and the yen, and the Canadian. These are the major pairs. Now there are a couple of others. We've also got the Australian dollar and the New Zealand dollar. These are what are considered to be the major currency pairs. They're paired up directly with the dollar. Of these, there are two which stand out far and above as the most active and the most liquid. Those are the euro and the pound. Now we're going to do our focus on these two currency pairs. We're specifically trading the British pound. The reason why I like to trade the British pound especially my momentum day trading, is because it's most active. You're going to have the biggest range, you're going to have the biggest moves. For a momentum trade, and we'll talk about this in earnest deeper in the course, for a momentum trade, what we're looking to do is get a small chunk. If the market's making a move, we want to get a small piece of that. And in order to do that, we have movement. The British pound is one of the fastest moving currency pairs on the market, and it's also the most liquid. Now let's talk about liquidity. Liquidity. What does it mean? Well, liquidity simply means that if I want to sell, I can sell, and I can get a price that I like. But let's take, for example, if it was the middle of the summer, say it's June, July, or August, and you wanted to sell your snow parka. There'd be a lot of demand for it, okay? Especially if you're selling a snow parka in the ski area. There's just not a lot of demand because there aren't that people in the ski area. You've got the locals and you've got maybe a few vacationers, but probably not interested in buying a snow parka. Let's take the flip side, and let's say you're in Nome, Alaska in the dead of winter, and you are the only store in town that sells snow parkas. Now, not only do you have a captive audience, there's also liquidity. You can sell the snow parka pretty much anytime you want for the price that you want. That is liquidity. And even though the market is 1.9 trillion, that doesn't mean that it's always liquid. Now, what do I mean by that? I mean, if you start trading some of the, like, let's say the British pound, Japanese yen, or the British pound, Swiss krona, you may not have many people that are looking to take trade. Remember, 85% of these transactions are done against the US dollar. So even though the market as a whole is big, it's still concentrated in just a few currency pairs. That's, again, why we focus on the main currency pairs, specifically the most active main currency pair, the British pound. The pound sterling is also called the cable, and it's also called just the sterling. So throughout the course, I might refer to it as GBP, I might refer to it as the cable, or I might refer to it just as the pound. It's one of the old currencies around. It's also most stable. It's one of the biggest economies in the world, and it's very active. So all of these reasons are why we focus in on the British pound US dollar pair. Let's talk a little bit more about how these currencies move. Now, as with any currency transaction, remember, if we're leaving US, where we have dollars, and we wanted to go to, let's say, Britain, we'd have to buy pounds. This would be an exchange, right? In fact, if you're at the airport, you're going to see a sign that says exchange, right? Probably currency exchange. And what they're going to have is a board which tells you where they are willing to buy and where they are willing to sell. So anytime you're in a currency transaction, you deal with buying and selling. Well, let's talk about what you're buying. Now, since the market is dealing with exchanges, with buying a currency, remember, a currency is not just one, it's two. Buying the pound against the dollar. So, when you're making the currency exchange, you're going to buy pounds and you're going to be selling dollars. Now, you don't have to focus in on this, that your broker will calculate this all for you. But because the way the forex market is made, you always are exchanging two currencies. So if you're going to buy pounds, you're going to have to sell dollars anytime you do it. Now let's take the side of that transaction. You are going to sell pounds. It means you have to buy dollars. Remember, 85% of all forex transactions involve the US dollar. You don't have to worry about this. So you don't have to worry about what you do to exactly exchange pounds for, or dollars for pounds, or pound for dollars. Your broker will handle all of this for you. All you need to concentrate on is, are you selling or are you buying? Now, why do we do it this way? Well, we do it this way because of the exchange transaction and how the current market is set up. The way around it, all brokers are the same. Everywhere you go, it's going to be the same. We're exchanging dollars for pounds or exchanging pounds for dollars. That is a pure function of what's called a free floating currency. Now, I said I wasn't going to make this a stuffy history lesson, but this is important so you understand exactly what you're trading. Now, you're looking at, later on, I'm going to show you some financial charts. All you need to be concentrated on is the chart going up or is the chart going down? If the chart's going up, we look to buy. If it's going down, we look to sell. It's that simple. You don't have to track which is being against what. You don't have to worry about making the exchange. How many dollars is the pound? All you have to do is focus on, do I need to buy or do I need to sell? Your broker, it's called a dealing desk. Your broker dealing desk software will take care of everything for you. And in fact, later on in this course, I will go over in detail exactly how to place orders, how to look at your broker screen, what everything means, how to read the PN. All of that will be taken care of. Okay, let's wrap this up. The Forex market is a 24-hour market. What does this mean? Now, we have to use some practical thing here. Is it true that you trade any time within the 24-hour period? Absolutely. But let me ask you this. Can you stay up for 24 hours a day, all day, every day for a week? Certainly not. In fact, exactly the opposite. We have to sleep. So the Forex market follows the sun around the world. So let's look at Tokyo. Tokyo opens up at 7 p.m. Eastern Standard Time. Tokyo closes, this is the open, Tokyo closes at around 4 a.m. Eastern Standard Time. So for traders that are up and they're trading from 7 p.m. to 4 a.m. Eastern. The session that opened, remember as the sun is moving here, is going to be London. Now London is far and away the largest currency center in the world. It's the oldest, and this is where you're going to find most of the action. And this runs from 3 a.m. and then close, remember this is Eastern time, until right about 12 noon Eastern Standard Time. So it opens at 3 a.m., it closes about 12 noon Eastern. And inside of this session, you're going to have what I call a sweet spot. The sweet spot in London is from 4 a.m. Eastern Standard Time until 10:30 a.m. Eastern Standard. This is the sweet spot, which means most of the activity, the big moves are going to come around this time frame. Now, you'll see the moves continue on into the next session, which of course is New York. New York opens at 8 a.m. Eastern Standard Time, and it closes at 5 p.m. Eastern Standard Time. The critical time right here, and it's called rollover. Now, rollover happens at 5 p.m. Eastern Time, and in fact, you may find that your broker shuts down their desk, meaning you can't trade at all, from about 4:58 p.m. Eastern Standard Time, and they'll close it until usually 5:05 Eastern Standard Time. This is so that they can do a couple of very important things. And again, this has to do with the history of the Forex market.